I think it's very hard to see how this one can get through without the sort of publicity in financial markets that will destabilize the whole system and bring the euro come crashing down.
Here at Liberty in Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty in Finance. We're always privileged to have this distinguished returning guest. Alasdair MacLeod, a former bank director and now the head of research at goldmoney.com, joins us this Monday, July 11th, 2022. Alasdair, on behalf of all of our viewers who are always eager to have you back, thank you for coming back on Liberty in Finance.
That's very much my pleasure, DK.
There's quite a contingent of your following on our channel who say that they rely on your monthly visits here to give us a global perspective. You live in the UK and you are very close to the Eurozone there. You give us a banker's perspective, looking at the credit markets, which, as many analysts have warned us over the period of time, dwarf the other markets. They dwarf the equity markets, they dwarf so many things, and in fact are likely to be sort of, if a stone gets pulled from the dam, that's likely to be the dam that might crack and burst. In fact, you've been pointing out to us cracks for some period of time appearing in that huge, almost unthinkably large edifice of the global debt and credit system. So let's start first, though, with one of the things you've cautioned us about for the last year or so is the intense weakening of fiat currencies around the world. And in fact, the US dollar, the euro, the yen, others. But right now, one of the concerns has been a global pivot away from the US dollar. Geopolitical events, including the Ukraine crisis, et cetera, have fomented the US dollar, the SWIFT system, et cetera, being used as a tool of sanctions against political opponents or adversaries, that sort of thing, to punish people by withdrawing their ability to transact in the US dollar. But that's not the beginning of the pivot. The pivot's been going on for about a decade. But right now, a big event got announced over the weekend is Saudi Arabia being in talks with the BRICS nations, this consortium of non-US and non-Euro nations primarily, who are creating their own ability to do major transactions, including oil transactions, outside of the dollar. And even though the dollar is nominally the world's reserve currency since Bretton Woods and the end of World War II, basically saying we're not under the thumb of that anymore, we can go do our own thing. But Saudi Arabia has been a longtime ally of the U.S., at least nominally, and supposedly a linchpin in OPEC, et cetera, and this whole petrodollar. Can you talk to us about what you're seeing and what you think the import is of these stories that just came out this weekend about Saudi Arabia being in talks to join the BRICS nations?
Yeah, sure. I don't think it's actually that much of a new story because, I knew back in 2014 that holders of gold, Arab holders of gold, were sending in 400-ounce LBMA bars to the Swiss refiners to get them refined into Chinese 4.9s, 1 kilo bars, and then they took them back into storage. So you sort of think, why are they doing this? There is only really one answer, and that is that they see their long-term future being in Asia. They want their gold, if you like, to be, conform with Asian requirements rather than London's or America's requirements. So I think that was a very, very clear signal back in 2014. And I got that when I had a conversation with one of the directors of a major refiner, Swiss refiner. And it did surprise me at the time. But anyway, that's the only conclusion I can come to. So this recent story about how Saudi Arabia is eyeing up joining the BRICS doesn't really come as a huge surprise. I think that the relationship between Mohammed bin Salman and the American establishment has actually deteriorated quite significantly recently. And it hasn't been helped by accusations from American intelligence services made public that they are convinced that the murder of Khashoggi, the journalist who disappeared into the Saudi embassy in was it Istanbul? I think it was Istanbul rather than Ankara, was on the direct instructions of Mohammed bin Salman. Now, that doesn't exactly do the relationship between this new autocratic ruler, who, in my mind, actually is following very much, when you look at what he's doing, he's following very much the sort of Machiavellian playbook, if you've ever read Machiavelli's Prince, the recommendations for a ruler to retain power or to get power and retain it. He's done exactly that. I mean, the way in which he dealt with his own family to ensure that he got the succession was really pretty ruthless. And again, I thought was completely out of Machiavelli's Prince. It had all those fingerprints over it. Now we have the situation where President Biden is meant to be going to visit Saudi Arabia later this month. He, so far as I'm aware, had not admitted that he was going to meet Mohammed bin Salman, this being a sort of a wider OPEC oil conversation with President Biden trying to get the oil producers to increase their production to sort of help deal with the shortages as a result of sanctions against Russia. So, but on the other hand, Mohammed bin Salman, his officers said, yeah, we got a meeting. Now we have the situation where presumably President Biden is embarrassed, if you like, at the idea of meeting this chap who dismembers people he doesn't like in foreign embassies or in his embassies abroad. So you've got this sort of wokeness, if you like, which is getting in the way of this whole thing. Whereas as far as Mohammed bin Salman is concerned, yeah, we're meeting. And if he doesn't want to meet, I don't care, sort of thing. And I would be pretty certain that in that meeting, if it takes place, that President Biden will be told some home truths. That would be very much Mohammed bin Salman's style. The last I heard was that this trip might be off because it's too long for an elderly president or some similar sort of story. Cock and bull story, I think it's quite simple. I think that the American delegation realized that this was going to backfire on them hugely if they went ahead with it. So what actually is he doing? I mean, the answer goes back to what I discovered back in 2014. I think Mohammed bin Salman sees his future very much, or his nation's future, very much aligned with Asia, the Asian continent. Whether he's read Halford McKenna's geopolitical theories of 1905, 1915, whenever, about the world island and how that is the center of the world geopolitically and all the rest of it, I don't know. But it all seems to be coming together in that way. And really what we're seeing is that the American dollar hegemony is now failing. It is certainly diminishing. All commodity prices are still priced in dollars and so on and so forth. So even if you're Chinese and you've got to try and buy commodities outside China, then unless you can persuade the seller to deal in another currency, you have still got a deal to be done in dollars. So the dollar is still very, very much top dog in that sense. But, we saw that from the Russian point of view, dollars are completely worthless now because they've got it in their reserves, but they can't use them because of sanctions. And the same is true of their euros and what they call the other currencies of the unfriendlies, yen as well. So, if these currencies are absolutely worthless, at the stroke of a pen from the leading member of NATO, then where does that leave all the other nations in Asia? Where does it potentially leave Saudi Arabia in the long term when they see that they have got to move away from the petrodollar world, as it were, and the world of American influence? I think it's quite clear to them that they have got to start thinking in terms of their future in Asia. They have got to start thinking in terms of accepting payment in other currencies, which basically means the end of the petrodollar. And it's all happening before our eyes. So, yes, DK, you are absolutely right to draw attention to this story. I mean, I don't know to what extent it has actually happened yet, but definitely Saudi Arabia is making moves in that direction. And remember that Saudi Arabia has got to look at this from the point of view of the whole of the Gulf region. They're sworn enemies, partly on a religious basis, I guess. On the other side of the Gulf, Iran is also a major oil exporter. And more importantly, it controls the Straits of Hormuz. So Iran could actually block everything that comes out of the Persian Gulf by sea. And guess who is allied with Iran? Russia. So, there are big things here. And I would not be surprised if this oil story hots up even more, that there will be fears of actions in the Straits of Hormuz to restrict the flow of oil out of the Gulf. And not only that, but it hasn't been hitting any Western newspapers at all, so far as I'm aware. But the Houthis in Yemen have been shelling oil tankers in the Red Sea, opposite Yemen and the Straits of Djibouti. So this is a very, very hot subject around here. And I think that Mohammed bin Salman, is playing this one very, very carefully because of this wider geopolitical scene. He has got to cuddle up with the Russians. And I tell you the other thing that was fascinating, I think it was back in 2019, there was a meeting, a G20 meeting, where you had the Saudis. I think they hosted this. And also in those days, Putin wasn't quite persona non grata, so he attended the meeting. And there was this extraordinary moment where Putin and Mohammed bin Salman high-fived each other. Now, this was an extraordinary gesture. And when you looked at the faces of the two of them, it was quite clear that there was some sort of secret pact between them. And it was going their way, high five. And it was just a moment, and they turned away. And it was fascinating, absolutely fascinating for any observer of the psychology, if you like, of these G20 meetings. So, yes, this is a very, very important juncture, I think, in the future for Saudi Arabia, and indeed for the whole of the oil market. It's going to be fascinating to see how this one plays out.
Sounds like we need to watch closely developments in the Middle East there regarding the petroleum supply for the world. But there's the other part about this that we didn't really talk about, how that would play out if indeed there is this accelerated pivot away from the US dollar by a significant participants in oil trade globally, including Russia, China, etc., and Saudi. What do you foresee from your analysis as a former banker, as a credit market student, that sort of thing, as far as what would the U.S. dollars, because some people have talked about floods of U.S. dollars coming back to the U.S. and driving debasement of the currency, making it much more obvious to people living in this little bubble that we are within the States, that suddenly if there's trillions of dollars coming home, what that would do to the financial lives of ordinary Americans. How do you see that impacting potentially the global balance of currencies and the U.S. People?
Well, sticking with the oil story for the moment, I think what it means is that in the long term, possibly the medium term as well, you're going to see ownership of dollar currency reserves by foreign central banks and foreign corporations and so on and so forth, they will probably on the margin be sellers of the dollar. But that's not actually something which is happening at the moment. What's happening at the moment is a flight out of the other currencies. The dollar is seen as a safe haven from a collapsing euro, a collapsing yen, and also a collapsing sterling. So that's what's driving the dollar at the moment. But we mustn't forget that in the background, fully $33 trillion of financial assets and bank deposits are owned by foreigners. I mean, this is what, almost 1.5 times US GDP. This is a very substantial figure. And anything that could upset the world view of the dollar could lead to a flood out of the dollar of this enormous amount of foreign-owned interest. Now, I think I'm right in saying, I haven't got the figures to hand, but I think I'm right in saying that something like 14 trillion of that is invested in is portfolio money, if you like, rather than strategic money or, country ownership of US treasuries, that sort of thing. So if we have to just call it portfolio money, there's about 14 trillion of portfolio money. Now you can see that we're now entering a bear market. We are in a bear market, I would argue, quite firmly, for equities and also bond prices. And so on that basis, you begin to think, well, at some stage, the foreigners are going to start liquidating their portfolios. That, I think, is a real danger, and that's an imminent danger. But it doesn't mean to say that they sell both their shares in Google or Apple or Tesla or whatever and dollars at the same time. What it might mean is that there is a shift from ownership of financial assets into a larger amount of bank deposits. So we need to watch that one quite carefully. But that is, I think that's a story slightly for tomorrow and the day after tomorrow. It's not actually what's driving markets at the moment. What's driving the markets at the moment, for the dollar anyway, is money coming out of other currencies who really, certainly in the case of Japan and the Eurozone, cannot get interest rates up. They're stuck beneath the zero bound. Systemically, any rise in interest rates beyond a certain point, and we're talking about a point not very far from current levels, will destroy the complete system. So, when you look at the situation, I don't know if you want to come on to the Eurozone.
Yeah. Let's talk about that before we get into because you've written and spoken extensively about the weakness in the euro and the Eurozone and the weakness in the Japanese yen. We want to talk about both of those because it's interesting when things have really broken down historically. It's not always in the place that everybody's looking. They're looking at the castle on the hill, and it's actually the dam or the moat or the whatever, the thing that fails that ends up causing this systemic upset that ends up undermining the whole balance of the apple cart. But before we get there, one of the images that keeps coming to mind as you talk about the relative strength of fiat currencies that has stuck with me when people have brought it up is if you've ever seen, viewers, if you've ever seen a video of a team of skydivers all falling together, they're in free fall, they've left the plane, they have no further means of support, they cannot be rescued, they're on their way down, but their relative position can change depending on their postures and so on. And so to belabor and argue about which of them is closer to the ground at any moment. Oh, look how much relative strength that one has versus that one. They're all in free fall and they're beyond hope. Reminds me of when you talk about the relative strength of the dollar versus the yen versus the euro. Remember, they're all plummeting towards the ground. And there may be shifts between them along the way down, but that's not to be confused with actual strength, actual store of value, that sort of thing. But you've written, or you're in the process of writing, about new evidence of imminent trouble in the euro and the Eurozone. Could we start there? You've warned us about that for some time. In fact, our last couple of interviews touched on that quite significantly. Can you talk to us about what this new evidence of trouble is that you're seeing in the euro and the Eurozone? Yeah,
I last really looked into this, and particularly the Target 2 settlement system and the problems hidden in that. I last looked at this, I suppose, about a year ago, so I thought it was time for an update. And what I have seen is that the situation has deteriorated significantly from when I last analysed it. I mean, when you look at the debt, if you like, of Greece, that has increased from, it's increased about fourfold, something like that. I mean, so just huge, absolutely huge. It's increased substantially, obviously, in Spain and also with Italy. I'm talking about debt actually in the Target 2 system. So, while Germany's what's owed to the Bundesbank is relatively stable at about 1.16 trillion euros, underneath all this, the situation, particularly for Greece, is deteriorating. And also Spain and Italy. Now, what do I mean by deteriorating? Those banks basically owe money into the system, into the Target 2 system. Why do they owe money into the Target 2 system? Because if you chase it through their balance sheets, what they've done is they have put that against an asset, because that's a liability to the central bank into the Target 2 system. On the other side of their balance sheet, it's matched by an asset. And that asset basically is a loan to their national commercial banking network. So what they have been doing is they have been effectively bailing out their own national banking systems. Now, the other thing which is very little followed is a parallel problem, and that is the repo market. Now, just to remind everybody, I know that repos can be very, very confusing. Basically, in a repo, what you do is you put in collateral into your central bank in return for cash, and it gets reversed later. But if you continue to roll the position, of course, it never gets reversed later. I mean, it gets reversed, but you renew it. In the old days when we had account trading in London, we used to call it cash and new. In other words, you never actually pay for this cash, as it were. You just roll the position, roll it ad infinitum. It's very hard to come by numbers on this, but the International Capital Markets Association produced an estimate of the size of the repo market in the Eurozone at the end of, I think it was the middle of last year, middle of 2021. Now, for reference, we get very excited when we see that the reverse repos, which is similar sort of thing, but it's the other way around, in America has just hit $2 trillion. Wow, God, $2 trillion. Do you know what the size of the repo market is in euros? 8.7 trillion euros. It is far larger than anything you Americans have got. Far, far larger. And of course, this is the other side of what's been going on, or some of it is the other side of what's been going on in these Target 2 imbalances. But what happens basically in Italy? I mean, if you go back to, I think it was 2012, 14, I think it was, the level of non-performing loans was something like 13%. I mean, this is huge when we think about it. If you think of sort of average bank, which is geared, balance sheet gearing, and yet 13% on average of their loans are non-performing, bad debts, in other words, or about to become bad debts. Well, there is a solution for this. And basically what happens is that the bank regulator in Italy turns around and says to the commercial banks, well, I'll tell you what, I will sign these loans off as performing if you get rid of them into the central bank, into the Banca d'Italia, by means of a repo, but get it off my patch. Okay, so what happens is, go along to the Bank of d'Italia, let's do a repo, and here's the collateral, a bundle of stuff, which has been signed off by the local regulator as performing when he knows actually that it's a bag of worms. Yep. So what happens is that you find in the settlement system, there is an unknown quantity of bad debts which have been funneled into it. But the people who set up the Target 2 system say, well, you know what, I don't know how it's being used. I know originally the idea was that it would all balance out, you know, and there would be no big, sort of differences because capital flows would sort of, you know, compensate for this, that, and the other thing. But of course, ever since the Lehman crisis, this is a problem that's just grown and grown and grown. So we have a situation where on paper, it doesn't look terribly bad, because if you get, the Bundesbank's money owed to the Bundesbank, it matches all the other stuff. So, you know, the guys who are owed money through the Target 2 system match literally to the cent the stuff that's owed into it by the debtor banks. So we have this situation which was interesting because it was a German economist who first pointed this out. And then the head of the Bundesbank at the time, a guy called Jens Wiedmans, he got a team in the Bundesbank to look at this situation. And sure enough, they found pretty much what I've just said. The findings of that were not made public, but it led to a letter which Wiedmans wrote to Mario Draghi, who was head of the ECB at the time, demanding better quality collateral and tighter lending standards. And in other words, you know, stop this practice of putting crap into the Target 2 system where we end up maybe not even being paid at the end of the day. So you can see that this was a really live subject. Now, what happened then was that Wiedemans resigned. He resigned, I think it was last year. He said he didn't want to renew his contract. So could he take early retirement? Now, this is code for, and there's no way it's anything different. This is code for a disagreement within the Bundesbank as to how to proceed in this matter. Wiedemans did not want to be in charge of a central bank where he knew that there was a substantial amount of debt in the system, which everybody was turning a blind eye to. He was not prepared to do that. Wiedemann is a hard money man, incidentally, so that you know where he is coming from. He's not one of these inflationists at all. He is a hard money man. So he's got out of the system now. And that quite clearly shows that the inflationists in this sit on the problem. Don't talk about it, hide it. But you can bet your bottom dollar or your bottom euro, if you like, that somewhere in the bowels of the Bundesbank, that report is still there. And it will have provoked, I think, secret committees to look at the possibility that the euro system might fail, and what would the Bundesbank do under those circumstances. And that is essentially what I was writing about. So to sum it up, the system is under even greater strain. Another little point about this. What's happened since interest rates turned? The bond yields on German government bonds and French government bonds and Spanish government bonds and all the rest of it, they've all risen. And around about, I think it's about 33% of the bonds that have been bought by the euro system are actually corporate bonds, so they will have a higher yield. And if you make a broad brush assumption, this is probably worst case actually, that the average maturity is 10 years, then that gives you an idea of the scale of the losses. Well, so far, I reckon that if that is the case, they've probably lost around about €750 billion on their bond portfolios. Now, when you bear in mind that the euro system is capitalized at around about 109 billion, compared with $750 billion losses, they're deeply underwater. And now, obviously, what would happen is that the first line of defense is that the ECB would turn around and say, well, we won't bother marking this to market because we're going to hold them to maturity. So, yeah, sure. Okay. But what happens if interest rates have to rise even more and bond yields rise even more? Well, You can see that they're sitting on the problem and they're just trying very, very hard not to become public in any way. And the inevitable consequence, as John Law found out in 1720, is if you keep the interest rates down, if you push money into the system to try and support your asset prices, then your currency goes for a battle. What's happening to the euro? As we speak, it's threatening to cross under 1 to the dollar. That's quite a fall. It's a similar problem in Japan. I mean, the other distinguishing problem in terms of sorting out the euro system is that the ECB itself is not owned or responsible to the government. Its shareholders are the other national central banks. So what we need to imagine is a situation where not just the ECB needs recapitalization, but all the national central banks as well, or at least the majority of them. Now, just imagine the parliamentary debate in Berlin, whereby the law, there's an attempt to pass a law to allow the Bundesbank to subscribe for new shares. I mean, I can just see the debate on the floor of the House. Well, what's the situation with these target 2 imbalances? Please explain that. Whoops. I mean, you can see that this is a very tricky situation. And I think it's very hard to see how this one can get through without the sort of publicity in financial markets that will destabilize the whole system and bring the euro come crashing down. Now, as far as we're all concerned, I mean, I don't have any euros. You don't have any euros. I'm sure many of your listeners don't have any euros. But we do have a problem, and that is that the euro system banks, the ones which are counterparties to American banks typically, the G-SIBs, are very highly leveraged. They have asset to equity ratios in excess of 20 times. Some of them a bit less than that, but the average is just over 20 times. And if you look at the share prices of these G-SIBs, some of them are as low as 27% of book value, 27 cents on the dollar. Now, that's option money, really, on a G-SIB's survival. So now imagine you get rising interest rates. Now imagine what happens to 8.7 trillion of repos, which is interest-free funding. Interest rates start rising. What do? They've got to start contracting bank credit, because the other side of that cash that comes in against all the rubbish that they've siphoned out into Target 2, the other side of that is their loan book out to whoever they lend money to. So if the cash coming in starts flooding out, there's only one thing they can do, and that's call in loans. So you have got a real banking crisis developing within the commercial banking network, and any American bank is just going to run scared of having anything to do with this at all. But it's very difficult to avoid that systemic risk entirely. And the systemic risk that is emanating from Europe is also emanating from Japan. And between the two of them, and also the UK, incidentally, because, okay, we're in a completely different set of parameters, but look at sterling, if you like, as a poor man's version of the dollar, but without the street cred that comes from hegemony. So, I mean, we are very much the junior player in this, and we are seen, if you like, as risk on. We're a risky business, sterling, compared with anything else, and that's why all this money is just going into the dollar. It's getting the hell out of these other currencies. But if you look at Japan, where the commercial banking system, if you look at the G-SIBs, it's also 20 times asset to equity ratio. We've also got banks in this country like Barclays, which are very heavily exposed into derivatives. You've got Hong Kong, Shanghai, which is exposed into Japan and that part of the world. Same with Standard Chartered. That's 3 of our G-SIBs. I don't think we got any more. I think those are our 3. So, this is a potential banking meltdown that we're looking at. The only way it is delayed is if you have a pause in the rise in interest rates. If suddenly we begin to believe that, after all, these price rises are transient and we're going to come back towards the target of 2% and all the rest of it, so the panic is over, then we live a little bit longer, because the real thing that's destabilizing it all is rising interest rates. But, we're then, I think, getting into the question of the purchasing power of fiat currencies, your, description of skydiving, as it were. Their purchasing power is going down. I mean, it's as simple as that. And this is not going to change overnight. And not only that, but I mean, I think it's almost dead certain that the oil story has got a lot further to go. And another point about the Eurozone is that I would describe Germany now as being on life support. I mean, it really is. They have got, they've been effectively cut off from most of their energy now, coming out of Russia, that is. And I mean, as, if you like, the engine, the production engine of the Eurozone, it is literally now on life support. It is a frightening situation. So a whole load of things are coming together. Even if we don't get the sudden rise in interest rates, fall in bond prices, rise in bond yields, even if that doesn't happen overnight, we have still got all these problems. And one way or the other, we'll probably wake up one morning and think, what's happened? I think it could be as sudden as that.
Your description of the Target 2 system in Europe for gathering up sort of all these debts that are being owed by the European sovereign banks, that sort of thing, central banks, into this system is a little bit opaque to people in the U.S. because we just haven't been following it very closely. But the one thing that impressed me about that when you've described that to us several times is that we've been warned by several analysts since the global financial collapse of 2007, 2008, that the next time we get this far, it won't just be Lehman Brothers or Bear Stearns or whoever that needs bailing out. It will be sovereign governments. It will be central banks that need bailing out. And when you describe that, it makes it sound like the mess has been pushed under the rug and pushed upstream, up the food chain to now where it can be hidden in this almost completely inscrutable place to most people. Who's in charge of that, and who are they answerable to, and how do you vote them out or get them to fess up or tell you the true accounting of their, to do an audit, that kind of thing. So in other words, we've been told by others, as perhaps unstable as the credit system might be, we're not in as bad a shape as we were back in 2008, whether it's in the real estate market. We don't have these crazy loans being given to people who don't have credit worthiness. We don't have lending going out to the extent that it was back in there. And the bank ratios aren't as bad in the U.S. So we're not on as slippery a footing as we were back in right before the global financial collapse. But that may be, is it not, just because all these problems have been pushed upstream to where now in fact the problem might be an order of magnitude larger, but it's just up at another different place in the food chain, higher up, that it could be more systemically impactful should it fail.
Yeah, no, that's right. As to your comment as is an elected official responsible for this? The answer is no. There's no democracy in Brussels, I can assure you. There's a sort of democracy in name only, but it's all controlled basically by the executive, who are unelected. I mean, they don't have to stand for votes, to get voted in or anything like that. And Christine Lagarde, who's the chairman of the ECB, was appointed as a safe pair of hands. Before that, she was chairman of the IMF, and before that, she was a finance minister in the French government. Some people like to point out that she was indicted on fraud, but she's a lawyer. We'll pass over that one. She was seen as a safe pair of hands, but the reality is that she's been given an impossible task. one task is to continue to do what the ECB has been doing, and that is to redistribute wealth from the northern countries to the southern ones, so that Germany, Holland, Netherlands, the Luxembourg, I suppose, and also Finland, within the Eurozone, they're effectively having their wealth removed from them through a system of depressed interest rates to below the zero bound, to sort of Spain, Italy, Greece, Portugal, and so on and so forth. So one of the things she had to do is to continue to do that, but that game is now coming to an end because rising interest rates brings that game to an end. It's as simple as that. And the other thing, I mean, she's presiding over a system which is so fractured. It's only a matter of time, and very, very little time, I believe, before the whole thing falls over. So she's got an impossible task. And I think to blame any one individual for this is really rather difficult. It's a systemic problem, as is so often the case. I mean, when you look at the Fed, for example, they've got, I don't know how many economists working on high salaries there, but they don't know anything about economics. And if I was to go in there and tell them a little bit of sort of Austrian economic reality, I mean, I would just draw blanks. I mean, I may as well talk to Paul Krugman. Forget it. We're on different planets. This is the problem. And so you have got this sort of systemic groupthink, which is completely rudderless in terms of where it's going. And now what they're doing more and more than ever before is they're just responding to the crises as they occur. And as you say, brush it under the carpet. There's something, there's a bit of dust over there. Quick, push it under the carpet. Yeah, so it's very much that's the way it works, I'm afraid. And it's the same with every central bank, really. They haven't got a clue what they're doing. The other aspect of brushing things under the carpet is, if you like, from an Austrian economic point of view, talking about the credit cycle, something which I call the bank credit cycle. They were not so definite on it. But unless you allow the excesses of one cycle to wash out when the cycle contracts, that sort of creative destruction which Schumpeter was talking about, though he wasn't actually quite talking about it in that context, but it does as a metaphor. Unless you allow that to happen, then you just store up trouble for later. And what central banks have been doing, I mean, particularly since Volcker raised interest rates to just kill the inflation bug stone dead back in 81, what they've been doing ever since is just brushing it under the carpet. Every time the bank cycle, which is roughly 10 years in duration, every time it turns down, they catch it. They expand the quantity of central bank money. They support the banking system. They push money into it. They push down interest rates. And by doing this, what happens is that the businesses that should have gone bust because they're, incapable of earning something to pay their debts, they're in effect tying up capital in the economy, which could otherwise be far better deployed elsewhere. That never washes out. And so we've had this time and time and time again. We very nearly came completely unstuck on the Lehman crisis, but they rescued it again. And now here we are, not 10 years later, 13 years later. This cycle has played out. It's been distorted, I think. You could argue it's been distorted to some extent by COVID, but we're now 13 years. This is very long in the tooth. So when this crash comes, I think it's going to be like a tsunami because of all the stored up brushing under the carpet, as you put it, that's been occurring ever since 1981.
Now, you mentioned to us a couple times in the past about the Japanese central bank, their determined stated policy to defend their bond low interest rate at all costs, and you're saying the cost is going to be the demise of the yen. You have recent evidence of the breakdown, sort of that policy of doom playing out. Can you talk to us briefly about that?
Yeah, I mean, what happened originally? The Bank of Japan insisted that it was going to not let the yield on the 10-year Japanese government bond, JGBs, as they call them in the market, not going to rise above zero. Well, they modified that to 0.25%. The Bank of Japan's problem is, in a sense, quite similar to the ECB's, insofar as they have accumulated a huge, great portfolio of bonds. They've also got equities, believe it or not, which they bought in the market, packaged up into ETFs. And they've been doing this since the year 2000. So this has been going on now for 22 years. They've accumulated a lot of liabilities. They cannot afford to see interest rates and bond yields rise. So they're sitting on the bond yield at 0.25%. And, as we've discussed before, I mean, this is, I repeat, this is exactly what John Law did in France in 1720. Pushed down the interest rates, printed money to buy shares, support the shares in the Mississippi venture. What's the Bank of Japan doing? Sitting on interest rates and trying to corner the market in JGBs. I mean, it's exactly the same policy. And what happened with John Law was he destroyed his currency. What's happening with the yen? Well, it's now over 137 to the dollar. Bear in mind that the higher the number, the weaker the yen, because that's the way in which it's quoted. And that's going to continue. I mean, it's risen from about 110, I think, over the last year to 137. I mean, this is serious fall in the purchasing power of the yen on the foreign exchanges. It's not reflected, if you like, in domestic price inflation, but that is very, very distorted because, as I understand it, something like 40% of the items in the consumer index are actually subsidized by government. Things like travel and all the rest of it. So, they've got another way of fixing the numbers, which you guys haven't alighted on yet, but you probably will in time.
Well, every time we speak, it doesn't make me feel any better. I guess I feel more informed, but more informed about how big and how massive, how looming, how much growing, impending this imbalance, the systemic troubles are in the global and regional and sovereign banking systems, and how any major tipping of any of those over could pull the whole thing down. In the face of that, you've reminded us what people can do. Here we ordinary mortals trying to shuffle along here and take care of our families, take care of our children, our grandchildren, and our futures, to protect ourselves, to take a more defensive posture against this runaway expansion of risk by the central banks globally.
Yeah, I mean, it's the only thing to do is to try and get out of the fiat currency system. How do you do that? Well, the only way you can do that is to get into proper money. Gold is legally money and has been since Roman times. It was codified by Justinian back in 6th century, I think. So that was an awful long time ago. And it's, from Roman law, it has been adopted in everyone else's law, basically, indirectly usually. I mean, in this country, it was very indirect because by the time Justinian codified money, credit, currency, and its legal status, we'd already, the Romans had already left Britain. So, but it came up sort of thing through common law. But it was only really when the Court of Chancery was merged with common law in 1875 that we actually came and had complete confirmation that money is gold and all the rest is credit. And that is actually precisely what J.P. Morgan said in 1912 ahead of Congress. I mean, he wasn't expressing an opinion, he was expressing a legal fact, and that point is missed by most people. Excuse me. Quite a lot of your listeners, viewers, will, I think, sort of look at the price of gold and they see it sort of sinking and all the rest of it and think, don't make the mistake of looking at it as an investment. It's not an investment. Money is not an investment. Money is something that you hoard. You don't invest in it. The distinction is terribly important. And the reason that this really matters is that the markets and the gold price through futures is driven by the investment community. And the investment community are essentially Keynesian. They've all gone to university and learned Keynesian economics from high school level through, university, college, whatever. And for them, the safety is not gold, it's the dollar, which is why we're seeing the dollar rise. And if you look at what happened after the Lehman crisis, gold actually went down because these guys who are completely clueless about economics, as I said earlier on, they sort of think, well, gold is a pet rock, or, I prefer cryptocurrencies, or whatever their story is. The result is that there are no buyers for gold when this problem happens. No buyers for synthetic gold, paper gold. But I can tell you that the central banks themselves are quietly squirreling away gold on the dips, making it quite difficult for the bullion banks to actually get their books completely straight. And that's an interesting point. If the central banks are squirreling away physical gold, shouldn't you as well? I mean, because it's money. It is money.
That's funny because that the terminology of bad talking something while acquiring it is called bash and stash. And it seems like that's what's been going on at a very high level for some period of time.
Yeah, pretty much. I think it's a very good way of putting it. Yeah, I would agree.
Alasdair, if people want to follow your work and all that you do there, how should they get connected?
Well, go to Gold Money, hit the research tab. I publish an article every Thursday, and so you'll pick it up there. And I also do a market report on Fridays. I won't be doing one this Friday or the following Friday because I'm actually going to be away. But I've got a couple of articles lined up for while I'm away. So please go there, read them. Please understand it. If you disagree with it, I don't care. But really, we're in the business of trying to educate people to try and save something for the ordinary person out of state wreckage, which I'm afraid is getting more and more imminent.
And folks, you can make sure you don't miss a single episode with Alasdair or any of our guests by subscribing to our free newsletter at libertyandfinance.com. Just go to libertyandfinance.com and over in the left-hand margin, put your name and email address, click submit. You'll get a confirming email. Make sure you confirm and you'll be in. You'll get every single episode that we interview 9 p.m. Eastern, 6 p.m. Pacific, and way early in the morning in the UK. Every day, 7 days a week, we publish, and including all of our interviews with Alasdair. Alasdair, on behalf of all of our viewers here at libertyandfinance.com, thank you again for joining us.
That's very much my pleasure.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.